Hello, in this video, we'll be going through uncertainty in leases. What if a lease term is uncertain? What does that even mean? So a lease term, is how long the lease is for. It could be 6 years, it could be 24 months, but sometimes those length of time is not certain, right? Sometimes the lease is adjusted for any renewal or termination options, okay? So if those renewal or termination options are considered to be reasonably certain to be exercised, then those have to be, then the contract term, the lease term, needs to be adjusted for any sort of renewal or termination if it's reasonably certain that that will be exercised. Let's go through a quick example. Fill-Rite Dental Services leased kitchen equipment under a 5-year lease with an option to renew for 3 years at the end of the 5 years. So let's just write this out. We have a 5-year lease. I'm going to say 1, 2, 3, 4, 5. Right, 1, 2, 3, 4, 5. Okay, and then we have option number 1 is we extend for 3 years to 8 years, right? And there's an option to renew for an additional 3 years at the end of, okay, sorry. There's a 5-year lease and there's an option to renew for 3 years at the end of the 5th year and an option to renew for an additional 3 years at the end of 8 years. So we can extend for 3 years at end of year 5. And then the second option is, I'm just going to quote, extend for another 3 years at the end of year 8. Okay. The first 3-year renewal, so we're talking about this one, number 1, the first 3-year renewal option can be exercised for 1/2 the original and usual rate. So at the end of this 5th year, we can renew another 3 years for half the rate we've been paying. So we're going to assume that it's reasonably certain that we're going to extend this lease term by another 3 years, 6, 7, 8. So now our lease term will be 8 years. Okay, that's what the length of the lease term should be when you record the transaction related to the lease. Because option number one is known, that you know about it, when the lease commenced, when it began, that your rates will be cut in half after year 5, it's likely you're going to extend. So when you're doing your lease liabilities and right of use assets, depending on the types of lease, and you need to present value your lease payments, you're going to use a number of years as 8, not 5. Okay. You can't just, lease doesn't get just reassessed for the terms. There needs to be a triggering event that indicates a change in the economic incentive for the extension or termination of the lease. Meaning you can't just reassess the lease term on a whim. There needs to be something concrete, an economic incentive to do so. Let's go through an example. A lessee had no significant economic incentive as of the beginning of a 6-year lease to exercise a 2-year extension. So right now, this lease is 6 years. Let's just write it out. 1, 2, 3, 4, 5, 6. So this is 1, 2, 3, 4, 5, 6. Okay. By the end of the 3rd year, so right here, the lessee has made significant improvements to the asset whose cost could be recovered only if it exercised the extension option, making the extension of the lease reasonably certain. Okay, so they made some sort of improvements to the asset and they can only recoup their cost if they extend the lease, which makes it reasonably certain that they will. So the full term of the lease is now expected to be a total of 8 years with 5 years remaining. So at the end of year 3, we're gonna, there's 5 years remaining. So now at the end of the year 3, 4, 5, 6, so this is 7, 8, right? There's 5 more years, 1, 2, 3, 4, 5. So it extends out to 8 years. And at this point in time, at the end of the third year, this is really messy, but at the end of the third year, the lessee will need to remeasure their lease liability at the present value of the remaining 5 lease payments. So at the end of the third year, the lease liability is going to have a specific carrying value or outstanding balance. And what the lessee needs to do is now they have 5 payments, right? Because they extended the lease they now have a 5-year lease remaining, and they have to look to see what is the dollar, what's going to be their new lease payments for these next 5 years. They're going to have to present value those payments back to the end of year 3. So they're going to use n equals 5. And they're going to use whatever discount rate exists at the end of year 3 when they're reassessing that lease liability. Okay, so that's what they need to do. And then they need to true up their lease liability from what it was to what it is, which we'll go through right here. So, like I said, the discount rate for the new term is, meaning the discount rate is the rate that we use to calculate the present value of the lease payments. So the discount rate for the new term is the incremental borrowing rate of the lessee using market interest rates at the time of reassessment. So at the end of year 3, in our example, end of year 3, whatever the interest rate is at that time, that's what you're going to use to present value those lease payments, those new lease payments for the next 5 years. Now, assume that the present value of the remaining 5 lease payments totaled $400,000, while the current balance of the lease liability before remeasurement was $250,000. So what we're saying is on 12/31 X3, our lease liability was $250,000, but when we take our 5 lease payments and present value them, it should be $400,000. So we need to increase our lease payable by $150,000, and we're going to increase our right of use asset by $150,000. We're going to record this journal entry. And then $400,000 will now be our new lease liability that we're going to amortize down between the payments and interest expense. Whenever there's a change in the lease term, the lessees need to reassess the classification of the lease. So there's 5 criteria that they need to go through to determine if the lease now meets the criteria as a finance lease. There's a whole other video going through these 5 criterias. If you are not familiar with them, please go watch that. But depending on now that there's a new lease term, the classification could change, and because the present value of the lease payments changed, there's several factors that could lead to a change in the lease terms. So they need to go through that, and if it changes, then the lessee must account for the lease. Like if it does change into a finance lease, if it was an operating lease and now is a finance lease, then it has to be accounted for as a finance lease for the remainder of the lease term. Okay. Lessors, right, the owner of the assets, are not permitted to reassess the initial determination of the lease term or the discount rate. So they have no change. Doesn't matter, right, for the lessor. We're only talking about the lessee side here. So far, we've discussed uncertainty in lease terms, right, how long the lease is for. Sometimes there's also uncertainty in the amount of the lease payment, right? And because the way the lease is written up is that the payment amounts, the lease payments, can increase or decrease in the future depending if a specified event occurs. So here's just some examples. For revenues, if a lease could say if you hit X amount of revenues when you lease out our buildings, then your lease payment will increase by X dollars. Or if you hit a certain amount of profitability, your lease payment may hit a certain amount of dollars. Or if we're leasing a piece of equipment and the lease payment that we have includes 1,000 hours of use per month for that equipment, and anything above 1,000 hours, you have to pay X dollars more in your lease payment. That's something dependent on a future event. So in that situation, there are portions of the lease payments that might be uncertain. We don't know what they will be. So how do we treat those portions that we don't know what they were? So what they will be. So here's a general account for uncertainty of payments. Because of the nature of those payments that they are uncertain, and sometimes it says often avoidable. That's TBD, maybe it's sometimes avoidable. We do not consider them as part of the lease payment. When we calculate the lessee's lease liability or the lessor's lease receivable, those are not considered, right? Of what might happen in the future, we're not going to even think about that when we record our lease liability and lease receivable. Now, what happens now? You fast forward to the future, and we do have an additional lease payment because we did hit that revenue marker in the previous example, and now we have to pay, $1,000 more than where our lease payment is on our lease agreement. Well, we're not going to go back and reassess or change our lease liability or lease receivable balance sheet accounts. Instead, we're just going to say, if I'm the lessee, I'm going to debit lease expense for $1,000, and I'm going to credit cash because I have to pay that out. And if I'm the lessor, I'm going to debit cash for the $1,000, and I'm going to credit lease revenue for $1,000. So we're just going to book it like that. Of course, as in all things accounting, there are exceptions, including when we have uncertainty in our lease payments. There are two exceptions when there's a variable payment, right, or uncertain, we don't know what it necessarily will be, that are included in the recording of the lease liability at the beginning of the lease. Okay, the first one is when we have these in quotes, variable lease payments are in substance fixed payments, right? They're really fixed payments in disguise, such as fixed minimum increases, right? It says they're variable, but really you know that you're going to know the amount. So here's some examples. Let's say the lease says the tenant pays actual taxes, right, of the property taxes of the building, but never less than $12,000 per year. So in that situation, we know the $12,000 is fixed, and only the amounts above the $12,000 are variable. So for this lease, our lease payments that we're going to record our lease liability and lease receivable, lessee and lessor side, is going to be $12,000, let's just say a year, right? We're going to present value those lease payments depending on the lease term. But it's the $12,000 is essentially fixed, even though it says only that they pay actual taxes, but never less than $12,000. Another example is, let's just say we're leasing a printing machine, and it's $1 per unit printed. That's how much the lease costs. However, the contract says you have a minimum of 50,000 units per month, which would be $50,000. So the $50,000 is in substance fixed, right? We know we will pay that amount no matter what. So that's really more like a fixed amount. The other exception of when to include a variable payment into the lease liability recording at the beginning of the lease is when the lease payment itself depends on an index or rate as the consumer price index or current interest rates. I want to go into an example just highlighting that part before we get to the rest of this slide. So I'm going to go down. Okay, so let's just say here's an example. If I have a lease term, right, no matter what I'm leasing, and it says the monthly payments are $1,000 times the consumer price index, okay? And the consumer price index when we, at the start of this lease, is 200. So my initial monthly payment is assumed to be 1,000 times 200, which equals $200,000. And I'm going to use the 200 for the whole initial calculation, even though the CPI, the Consumer Price Index, will change in the future. When I determine my lease liability and my lease receivable, I'm going to use my CPI at the beginning of the lease. Okay, so even though it is a variable index, right? Because it depends on the index. We're still going to book it on the beginning of whatever it is at the beginning of the lease. Now, in the future, that index might change. So are we going to change our lease liability every single year and lease receivable every single year? No, we are not going to change it. That would be a big nightmare. The only time we would change our lease asset or liability for an index or rate is if the lease is later remeasured for another reason, such as the change in the lease terms, a change in purchase option assessment, or some sort of other modification of the lease. Okay, then you can change the lease liability for one of these options, plus the change in the index or rate that was used in the beginning of the lease. That's the only time it's going to be updated. So let's look at another example. I have my annual rent is $50,000 times the current prime interest rate. And the prime interest rate at the start of the lease is 6%. So I'm going to assume that my rent is 50,000 times 6% equals $3,000 per year. Okay, that's what I'm going to record. I'm going to record $3,000 when I record the lease liability. Now, next year, the prime interest rate increases to 8%, and I'm going to now have to pay $4,000. Do I remeasure the lease liability? No, I don't, unless the lease is modified some other way or for some other reason. Okay, so if the lease is modified for another reason, then we're going to true up our lease liability to a new number. However, if it's not, then for this additional $1,000, right, because my lease payment, I recorded the lease liability based on a $3,000 payment, that $1,000 payment, assuming I'm the lessee, I'm going to debit lease expense for the additional $1,000 and credit cash for that $1,000, okay? Because that's when it's not modified. If it was modified, then that additional $1,000 payment will be built into my new lease liability amount. Let's do this concept check. On January 1, Brighton Early Vineyard leased a truck for a 5-year period, at which time possession of the truck will revert back to the lessor. Annual lease payments are $11,000 due on December 31 of each year, calculated by the lessor using a 4% discount rate. If Early's revenue exceed a specified amount during the lease term, Early will pay an additional $3,000 lease payment at the end of the lease. Early estimates a 70% probability of meeting the target revenue amount. What amount, if any, should be added to the lease payments used to determine the right of use asset and lease liability as a result of the contingent rent agreement? So we know that for sure when we're calculating the right of use asset and lease liability, we have lease payments. We're going to take the present value of the $11,000 of lease payments. Okay. Now there's based on using 4% and n equals 5. So I equals 4%, n equals 5, because that's the number of periods. Now, if they hit a certain revenue target, they're going to add another $3,000. However, early only estimates that it's a 70% probability of meeting that target revenue. So are they, what amount, if any, should be added to the lease payment, meaning added on top of the $11,000 that we know for sure we're going to present value? That amount is going to be zero because the 70% is it's uncertain whether they're going to hit that revenue target and have to pay that additional $3,000. So they will not include it in the initial lease liability or asset calculation and amount that's recorded.